Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
L3Harris Technologies is a leading defense electronics company. It was formed in 2019 through the merger of Harris Corporation and L3 Technologies, combining two complementary defense technology franchises into a single $18 billion revenue platform.
Harris Corporation traces its roots to 1895, spending a century building communication systems for the U.S. military. L3 Technologies brought expertise in sensors and electronic warfare. Together, they cover nearly every dimension of defense electronics.
The business breaks into three segments: space and airborne systems at about 40% of revenue, integrated mission systems at 33%, and communication systems at 27%, all serving the U.S. government and allied militaries.
The defense electronics moat is built on classified program relationships. Once L3Harris is embedded in a multi-year defense program, competitors cannot easily displace them without enormous disruption and cost to the customer.
About 85% of revenue comes from government contracts. That concentration creates strong visibility and predictability. A book-to-bill ratio above 1.0 signals new orders outpacing revenue recognition, maintaining a healthy backlog.
Electronic warfare is a strategic capability, managing the electromagnetic spectrum, jamming threats, protecting communications, detecting adversary systems, requires decades of specialized engineering expertise that cannot be quickly replicated.
Operating margins run around 10%. Free cash flow generation is approximately $2 billion per year, which funds both dividend payments and share repurchases. The company has raised its dividend for 23 consecutive years.
CEO Christopher Kubasik took over in 2021. He previously led L3 Technologies and held senior roles at Lockheed Martin, giving him deep operational and financial experience in large defense contracting.
In 2023, L3Harris sharpened its portfolio through divestitures of non-core businesses and redirected capital toward its three core segments. The company also had an attempted acquisition of Aerojet Rocketdyne blocked by the FTC.
The space segment includes satellite sensor payloads, ground systems, and tactical communications for space-based architectures. As governments invest in space-based intelligence and communications, this segment has growing strategic importance.
Competitively, L3Harris sits alongside Lockheed Martin, Raytheon, and Northrop Grumman as a Tier 1 supplier. It differentiates as a nimble electronics specialist rather than a prime contractor for full weapon platforms.
L3Harris has a 23-year streak of dividend increases and returns approximately $800 million annually to shareholders. That kind of consistent capital return record is relatively rare in the defense sector.
The long-term demand driver is straightforward. Geopolitical competition is intensifying, allied defense budgets are expanding, and the technological complexity of modern warfare continuously increases demand for advanced electronics and communications.
From encrypted battlefield radios in the hands of soldiers to sensor payloads orbiting hundreds of miles above, L3Harris technology is woven into the infrastructure of modern defense across over 100 countries.
That's the company chapter for L3Harris Technologies. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
L3Harris just printed a beat and raise on the back of the biggest defense spending wave in a generation. Q 2026, revenue up 12% to $5.74 billion. EPS came in at $2.72 versus the Street's $2.53 estimate, a 7.5% beat. Funded backlog hit a record $40.7 billion. Management raised the full-year guide. This is Charged Alpha. Let's break it down.
L3Harris is a $66.9 billion defense technology company, not a pure prime contractor like Lockheed or Northrop, but a mission systems specialist. They build communication systems, electronic warfare, space payloads, intelligence solutions, and now missile and munitions. The company was formed by the 2019 merger of L3 Technologies and Harris Corporation, then expanded its missile capability with the Aerojet Rocketdyne acquisition.
The story is exposure to the highest growth pockets of defense: classified intelligence, space-based ISR, electronic warfare, and munitions. NATO members are ramping defense budgets to 3% of GDP and beyond after the Russia-Ukraine conflict. The U.S. defense-based budget continues to expand. L3Harris sits in the middle of that demand wave. Funded backlog of $40.7 billion is roughly 2 times annual revenue, an unusually deep visibility window for an industrial.
Q1 numbers across the board. Revenue of $5.74 billion versus $5.13 billion a year ago, 12% reported, 15% organic. Operating income climbed to $652 million, lifting operating margin to 11.4%. Segment operating margin edged up to 15.7%. GAAP diluted EPS of $2.72 was up 33% year over year, helped by higher operating income, lower interest expense, and a lower effective tax rate.
Segment breakdown is where the growth signal lives. Space and Mission Systems revenue climbed 24% to $2.99 billion, with operating margin expanding 60 basis points to 10.5%, driven by classified ISR programs and international missionized aircraft. Communications and Spectrum Dominance was up 3% at $1.86 billion, with margin at 25.1%. Integrated Mission Systems and Missile Solutions posted 18% growth to $990 million.
The backlog story matters more than any single quarterly print. Orders reached $7.8 billion in the quarter, a book-to-bill of 1.4 times. That pushed funded backlog to a record $40.7 billion, roughly 2 times annual revenue. And that excludes another $25 billion of Munitions Acceleration Council orders under negotiation. Defense visibility this deep is the single biggest reason management can credibly raise guidance.
Margins are typical for the defense sector, thin but stable. Gross margin of 24.1% reflects the cost-plus and fixed-price program mix. Net margin sits at 7.3%. Defense primes don't earn software margins. They earn predictable, contracted multi-year revenue with low cyclicality. That's the trade. You give up margin expansion, you get visibility and downside protection.
Cash flow is the other key defense metric. Trailing 12-month free cash flow stands at $2.68 billion against operating cash flow of $1.96 billion. Management is targeting roughly $3 billion in full-year 2026 free cash flow. With a market cap of $66.9 billion, that puts the FCF yield around 4.5%, competitive with the S&P average and supportive of capital return.
Balance sheet carries the Aerojet legacy. Total debt of $10.44 billion against $1.07 billion in cash gives net debt of $9.37 billion. Equity sits at $19.64 billion. Leverage is elevated for the sector but manageable given backlog visibility. Management has been deleveraging since the Aerojet close, and another year or two of $3 billion FCF will materially reduce that load.
Wall Street coverage on L3Harris is constructive but not euphoric. The breakdown across major sell-side coverage is 4 buy ratings, 3 holds, and 0 sells. The average 12-month price target sits around $390, with a high estimate north of $440 and a low near $325. With LHX trading at $358, that consensus implies roughly 9% upside to the average target.
Valuation is the central debate. LHX trades at 26.6 times forward earnings on the consensus 1348 EPS estimate. Price to sales is 3.06 times. EV to EBITDA is in the high teens. By defense sector standards, that's a premium multiple. Lockheed and Northrop trade closer to 20 times forward, RTX in the low 20s. The premium reflects L3Harris's higher organic growth profile.
Bulls argue the multiple is justified by the backlog and the growth mix. 15% organic revenue growth in Q1 is meaningfully ahead of the sector. Space and Mission Systems at 24% and Missile Solutions at 18% are the highest growth pockets. If management hits the raised $23 to $23.5 billion revenue guide, organic growth for the year lands in the low teens, a multi-year reacceleration.
The hold camp is centered on sequestration risk. The defense budget has expanded steadily for years, but the political backdrop has shifted. Concerns about deficit-driven spending cuts, Doge-style efficiency reviews, or program prioritization could compress contract awards on a multi-year horizon. Holds are not bearish on the company, they're cautious on the macro budget environment that funds the company.
Beta is 0.75, well below market. Defense names trade with their own cycle, driven by budget appropriations and geopolitical risk premium rather than consumer or industrial demand. That low beta is part of the appeal for portfolio diversification. The forward revenue estimate is $25.2 billion for full year 2026, and forward EPS sits at $13.48.
The bull case rests on three pillars. First, NATO and European defense ramp. Member states crossing 3% of GDP creates a multi-year demand wave for communications, electronic warfare, and missile systems, exactly L3Harris's wheelhouse. International revenue is growing faster than domestic and carries strong margins.
Second, the classified and space-based ISR portfolio. Space and Mission Systems is growing at 24%, the fastest segment in the company. Classified contracts are typically the stickiest, longest duration, and highest margin work in defense. That mix shift is structurally positive for both growth and profitability over the next 3 to 5 years.
Third, the munitions opportunity. The Aerojet Rocketdyne integration, plus the Munitions Acceleration Council pipeline of $25 billion in pending orders gives L3Harris a credible path to becoming a top-tier munitions supplier alongside the legacy primes. If even half of that MAC pipeline converts to firm orders over the next 2 years, it materially expands the backlog beyond today's record.
The bear case begins with sequestration and budget risk. Defense spending has been on a one-way street for years, but political pressure on the deficit is real. A return to sequestration-style caps, Doge-driven cuts, or a multi-year flat budget environment would compress the entire defense complex. L3Harris is no exception, even with strong backlog visibility.
Fixed-price contract risk is a structural concern across the defense sector. When inflation runs hot or supply chains break, fixed-price programs can move from profit to loss quickly. L3Harris has navigated this better than some peers, but the quarterly margin variability in segments like Space and Mission Systems shows the operational difficulty of executing classified, technologically complex programs at scale.
Debt is elevated. $10.44 billion in total debt against equity of $19.64 billion gives a debt-to-equity ratio over 50%. Most of that came from the Aerojet acquisition. Interest expense weighs on EPS, and any deterioration in the credit environment makes refinancing more expensive. Deleveraging is happening, but not yet complete.
Valuation is the fourth concern. Trading at 26.6 times forward earnings is a defense sector premium. If organic growth moderates back to the sector average of mid-single digits, multiple compression toward the 20 times peer range could mean a 15 to 20% derating before fundamentals do anything wrong. That's a real risk for new buyers chasing the recent run.
The natural peer set is Lockheed Martin, Northrop Grumman, RTX, and Huntington Ingalls. Lockheed is the F-35 and missile prime, larger, slower growing, trading near 20 times forward. Northrop is the B-21 stealth bomber and space prime, comparable size, similar valuation. RTX is the broader portfolio with Pratt & Whitney engines and Raytheon missiles, diversified with commercial aerospace exposure.
Versus Lockheed Martin, L3Harris is faster growing but trades at a meaningful premium. LMT delivers steady mid-single-digit organic growth with rock-solid F-35 visibility. LHX is delivering low teens organic growth in classified and space programs. The premium is earned by mix and growth rate, but it leaves less margin for error if guidance ever slips.
Northrop Grumman is the closest comparable on growth profile. NOC has B-21, Sentinel ICBM, and a strong space business. Both LHX and NOC trade with similar premiums to the sector. The choice between them often comes down to specific program exposure, whether you want classified ISR concentration through L3Harris or strategic deterrence through Northrop.
RTX is the most diversified comp, but the least pure defense exposure. Roughly half of RTX revenue comes from Pratt & Whitney commercial engines, which adds aerospace cyclicality. Huntington Ingalls is shipbuilding focused, different end market entirely. For a pure defense technology growth story, L3Harris has the cleanest exposure to classified and electronic warfare among the large primes.
Options activity around the Q1 print was orderly. Defense names typically don't see explosive earnings moves. Implied volatility was pricing roughly a 3 to 4% move, and the actual reaction landed inside that range. There was no unusual concentration in directional bets, which is consistent with a beat and raise that the market largely priced in based on the strong backlog signal heading into the print.
Looking out further, the open interest skew in mid-2026 expirations shows a balanced pattern. Calls clustered around 380 and 400 strikes, roughly aligned with the consensus price target. Puts at 330 and 320 represent downside hedging tied to budget cycle uncertainty rather than company-specific concerns. That's a healthy positioning structure for a defense name.
Insider activity has been quiet. Defense executives typically transact through pre-scheduled 10b5-1 plans, given the regulatory sensitivity of classified contract knowledge. There has been no unusual concentration of selling or buying around earnings. CEO and CFO ownership levels remain at appropriate levels for senior leadership in the sector.
Institutional ownership is dominated by index funds and active defense sector specialists. Vanguard, BlackRock, and State Street collectively own a meaningful chunk through passive vehicles. Active managers like Capital Research and Wellington round out the top of the book. There's no Berkshire-style anchor holder, which means LHX trades on flows and fundamentals rather than headline holder dynamics.
Bottom line on L3Harris, a beat and raise built on the cleanest defense growth mix in the large cap complex. Record backlog, raised guide, and credible path to $3 billion in free cash flow. The risk is the budget environment, not the company.
If you own it, the thesis is intact. Ride the NATO and classified program ramp through 2027. New buyers should respect the premium multiple and watch sequestration headlines. Charged Alpha rates this a constructive buy with budget cycle awareness. Strong execution, political backdrop matters.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.